So we received an introduction to equity valuation at level 1. It was a relatively smaller part in the level 1 curriculum. Equity valuation and asset valuation in general forms the core of the level 2 curriculum. So a very important topic. Some of the concepts we may have studied in corporate finance and in other reviews and the process of discounting especially, but very important to revise them once again nonetheless and understand this topic very well. It's a heavy weight on this exam. So the initial readings give us an introduction to the process of equity valuation, and readings later on will delve deeper into the specifics and the exact valuation of different companies. So in reading number 30 of the curriculum, we'll understand the applications and the processes related to equity valuation, a relatively shorter reading. So valuation is the process of determining the fair value of an asset. Generally, 5 steps go into the valuation process. First, you need to understand the business, understand the product, the drivers of revenue, the drivers of costs, and use that understanding to forecast the company's performance. Once you have the pro forma statements and the cash flows projected for the reliable future, we will then, depending on the characteristics of the company, decide on an appropriate valuation model. So if it's a dividend paying company with constant growth, probably we'll use the dividend discount model. If not, we'll probably use a multiple based approach. So we will select some valuation model, discount our forecasts back to compute the value of the company, and apply the valuation conclusions, whether to buy the stock, sell the stock, or for whatever purpose we are doing the valuation. Intrinsic value is defined as the value of an asset estimated by someone who has complete understanding of the characteristics of the asset or the issuing firm. So intrinsic value is what we intend to derive from the process of equity valuation. To the extent that market prices are not perfectly efficient, the market prices or market values may diverge from the intrinsic values. The intrinsic value forecasted by the analyst can differ from the current market price of the company. And there are 2 reasons why that difference comes. First of all, the forecast of the intrinsic value may be incorrect. So the actual intrinsic value or the actual fair value can differ from what we have estimated. That is, we could have made a mistake. And secondly, the market could have made a mistake, or there could be inefficiency in the market. So the market price can vary from the actual intrinsic value of the firm. So the estimated intrinsic value from our previous process may differ from the actual price. Now, when we do equity valuation, we generally work with the going concern assumption. That is, the company is assumed to be operating in the foreseeable future as opposed to going out of business. When we do liquidation value, on the other hand, we try to estimate what would be the assets of the firm if they were sold piece by piece today, net of the company's liabilities. Fair market value is the price at which a hypothetical, willing, informed, and able seller would be able to trade an asset to a similar buyer. Investment value can be slightly different. So this is the value to a specific buyer after including any additional attributable synergies as may be in the company. So please note, there are subtle differences between the different terms that you've studied: liquidation value, fair market value, investment value. You don't need to memorize these. It's generally presented in the curriculum, so we'll go through them once, but they're more for your understanding and to give an introduction to the process of equity valuation. So equity valuation is the process of estimating value by using a model based on the variables that influence fundamentals, comparing the observed market value of similar assets, and these are the 2 broad categories of methods that we generally apply. So the first are a category of absolute valuation methods, and the second is a category of relative valuation methods. Both of them we'll study in more detail in the coming sessions. Why do we need equity valuation? There are various uses. It can be used in stock selection, for reading the market, that is, understand what price earnings multiple is the market trading at as compared to its historicals or as compared to other markets. Project the value of corporate actions. So the same processes and the valuation that we do for companies can be applied to specific projects as well, and whether embarking on them will add value or destroy value to a particular company. To give fairness opinions about a transaction or about a company, planning, consulting, communication with analysts and investors, valuing private businesses as we'll study in a lot of detail at level 2, and for the process of portfolio management. So it's a very useful activity that definitely needs to be performed with a lot of diligence and care, and we'll study how to do it in more detail. So Michael Porter gave a 5 forces model to evaluate the attractiveness of any industry. We now have a special reading on the 5 forces, so we'll delve deeper there. But generally, when evaluating any industry, we must check for the threat of new entrants. If new entrants can easily come in, then the industry is not so attractive as compared to an industry where new entrants cannot easily come in. There can be various barriers for reasons like size, differentiated product, complexity in manufacturing, etc. If the substitutes are easily developable or are easily available, then the industry is not very attractive. So the product that the industry is making can easily be substituted. Then that's not a good thing. The industry is not very attractive as compared to an industry where the product is not substitutable. Bargaining power of buyers should be low. So if there is one concentrated buyer in the industry, that is everybody is selling to just one person, then again the industry attractiveness is lesser. If the bargaining power of suppliers is high, then that's also bad. Suppliers are your raw material suppliers. So if you're dependent on just one person for all your raw material, then he may squeeze your margins or he may raise prices and you may be able to do nothing. So if raw materials are easily substitutable and there are many raw material suppliers available, then that's a good sign for the industry generally. Rivalry amongst existing competitors should be low, because if everybody is fighting a lot amongst themselves, and that means profits and prices and margins may be lower. We'll study these in more detail in the specific reading on 5 forces. So the attractiveness of any industry is determined by the interaction of these 5 competitive forces. Just remember: threat of new entrants, threat of substitutes, bargaining power of buyers, bargaining power of suppliers, and the rivalry amongst existing competitors. Now, generally speaking, a company may follow one of 2 strategies when operating in an industry. You could be the cost leader, that is the lowest cost producer of the product, and hence your ability to drive the industry and your ability to price products is much better as you're the cost leader. You could have a differentiated product, and hence you may not be the cost leader, but you enjoy a premium pricing because the quality or the functionality or other aspects of your product are better than the others. Companies can also follow a focus strategy, which is either of these strategies, cost leadership or product differentiation, within a particular niche segment of the industry. So for an auto industry or for a 4-wheeler industry, you're only catering to the luxury or high-end cars, or you're catering to the mass market. So focus is a niche segment that you're trying to service with any one of these strategies. Now, the process of equity valuation and the whole discounting and estimation becomes difficult if the quality of earnings is not very good. And often the quality of earnings may act as a deterrent. So these issues are normally addressed and available by reading the footnotes and the disclosures to the financial statements. So as an analyst or as a valuer, you must look out for acceleration or premature recognition of revenue. So if the company is doing that, that means it is front-ending the revenues and maybe trying to mislead the estimates. Reclassifying gains and non-operating income. So non-operating gains are being classified as operating gains so as to again give an impression of higher profitability. So gain on sale of land or any one-off income like that should be clubbed separately, should be reported below the operating income. If we club it together, then we'll give the wrong picture. Delaying expense recognition or classifying regular expenses as one-off expenses, manipulating amortization, depreciation, and the discount rates. We studied at level 1 how firms can do this, or how the quality of earnings can be suspect. So you must be careful about all these issues and other off-balance sheet items that the firm may be trying to disclose. So the firm may have given guarantees or may have had other arrangements that will not come up on the balance sheet as a number, but in the case of a default or in the case of some other happening, the company may be liable for a big payout. So all these items can affect our valuation and make the valuation process difficult. In absolute valuation models, we estimate the intrinsic value. So the dividend discount model, the free cash flow discount model that we will study will all be absolute valuation models. In relative valuation models, we estimate a company's or an asset's investment characteristics by comparing it to the value of other firms. So if one pen costs $10, the argument is a similar pen with similar features should also cost $10. So if one company is trading at a PE ratio of 10 times, then another company in the same industry and with the same business model should trade at a PE multiple of 10 times. Sum of the parts valuation is also done at times, that is valuing the individual components and then adding these values together to obtain the value of the whole company. So sum of the parts valuation generally needs to be done when the company is operating in multiple businesses. So if I have a chemicals business and I also have a textiles business and I have a cement business, then giving one multiple to the consolidated earnings often becomes difficult. So what we do is we separately value each of these parts and then sum it up to do the sum of parts valuation. And when we do a sum of parts valuation, we often find that there is a conglomerate discount. That is, the value of conglomerates or the market price of conglomerates, companies like these that have many businesses, tend to be lower than the sum of the individual parts. There are many reasons attributed to it. For example, analysts may not be able to discover the value easily or estimate the earnings easily because what is reported is the consolidated earnings and individual segment-wise differentiation is difficult. If companies have diversified into unrelated businesses, then management bandwidth may be getting used up in that unrelated business and hence market may be giving a discount. Thirdly, if capital is inefficiently being moved from good businesses to bad businesses. So a good business is generating cash flow, but instead of that being paid out as dividend, that is going to fund this other business. Then market may not pay a very high value to our good profitable business also because those cash flows are also not available to the shareholders. Some theory says that there is actually no conglomerate discount. It's just a hypothetical or it's a mistake that researchers do when calculating the value. So we've generally seen that there is some conglomerate discount. However, debate is still on as to what is the precise reason for that discount. So you could have an absolute valuation, a relative valuation. We'll focus our energies on these two methods. Sum of the parts is any of these valuations and then summing the various components up to derive the total value. When we do this, we realize that there is often a conglomerate discount, that the total value of conglomerates tends to be slightly lesser than the sum of the individual parts or the individual businesses. So which model should we use finally? First, you should understand the characteristics of the company. If the company is a dividend paying company, free cash flows are positive, and you are able to forecast earnings, then you can do an absolute modeling or you can do a dividend discount, a free cash flow discount. If projecting earnings is very difficult and earnings are negative or book value is negative, it's a loss-making company or it's a venture capital type firm, then you'll have to apply different models as we will see. So you may at times need to apply a relative valuation model At times you may need to apply a residual income type model, as we will study in the coming sessions. Then you should see the quality and availability of input data. So the residual income model specifically requires very high quality data, as we will see. So the model should be appropriate based on the quality and availability of input data. And finally, it should be suitable for the purpose of the analysis. If we just want to decide between two stocks A and B, then a relative valuation approach is better. If we independently want to decide whether we should invest at all in the market or not, then an absolute valuation type technique may be better. So that was just an introduction to the processes of equity valuation. We'll study the process of valuation and the specifics in more details in the coming sessions.